down
It
there.
is.
The
That's right.
volume of management was
So
whatever. They're doing what they want to do. It's a tough road.
Yeah,
So
that's a tough one
first
too,
month
because
is like,
you don't really get compensation.
Good afternoon.
No, there's not enough. There's no math there.
Right.
Thank you for coming. This is a session on finance and investment. We're going to talk about choosing the right project, and company to fund before you begin, because if you get halfway down, you have to keep going. And what kind of money will respond to your idea. We're going to talk about recent trends in financing for media production companies, and then we're going to dig into initial coin offerings, blockchain, cryptocurrencies. We'll give you definitions. We'll talk about the opportunities, the SEC and the other 80 regulators who are in the mess now, and some wisdom for your first steps. Okay, we're going to introduce the panel. It'll introduce itself first. Here's Steve. He'll be here soon.
Right on time. Sorry.
On the
I was
end.
making a big entrance.
Starting with Greg, since Steve's last. Greg, tell us who you are. Would you, well, I'll tell him who I am, then we'll tell him who you are.
Great.
I'm Joey Tamer. I'm a shadow CEO to early stage companies. I'm in the middle of a white label fund of an ICO, raising the first $10 million on a token, utility token. We'll talk about all that later. And I consult to early stage technology companies. I'm at joey@joeytamer.com. So would you give your URLs and your emails so they can find you later? And this is Greg.
Hi, everybody. Greg Axelrod. I am a partner at a law firm called Stubbs, Alderton, and Marklees. We are a 30-lawyer corporate transactional and litigation boutique. I had the internet, digital media, and entertainment practice there, which is to say that the core of my clients are those companies in those industries, and I represent them as corporate counsel, either as their outside general counsel or with respect to their strategic transactions. I'm also a general partner in a venture fund that we're looking to raise. It's an early stage venture fund called SAM Creative Ventures. We're looking to raise $10 to $12 million. We've got about 2.5 to 3 soft circled. We will close on 5, and it's going to make early stage digital and technology investments. URL is stubbsalderton.com, STUBBSALDERTON.com, and gaxelrod@stubbsalderton.com.
Jennifer.
Thanks. I'm Jennifer Post. I'm a partner at Thompson Coburn. Thompson Coburn is a national firm. We have about 400 lawyers coast to coast. I'm a partner in the corporate and securities group here in LA. In Los Angeles, we're about 30 lawyers. And my practice is in general corporate and securities. I represent startup companies and operating companies, mostly in California, but throughout the country. And I'm also on the other side of the table representing venture capital funds and high net worth investors doing investments in private companies and pre-IPO companies. I'm not going to try to spell everything. It's Thompson Coburn. You can look me up after the conference. I'll give you a card and we can connect that way.
I'm Jason Scoggins. Yep, jump in. I'm Jason Scoggins. I'm president of Slated. Slated is a platform that matches filmmakers and their projects with film financiers. The company launched in 2012. I've been with the company since 2014. My role is to participate in sort of the care and feeding of our scoring system for film projects, as well as run the single picture and multi-picture financing practice within Slated. My email is jason@slated.com, and you can check us out at slated.com.
Okay. Hello, my name is Brett Brown, and I guess I'm not as good and smart as these other guys. So I actually have three roles. One of which I'm the managing member, one of 3 of our family office, and as part of that, I'm also the managing director of a $125 million fund that invests exclusively into video games. And so we look to do, instead of equity or debt-based deals, but royalty-based deals. And then I'm also managing partner for a second fund that's in stealth mode, which is an IP-focused fund that focuses in on IP rights and doing, whether it's book publishing, films, and video games as well, but early stage. So Exola Capital, which is the $125 million fund, is late stage royalty, and as I mentioned, the second fund is the Stealth Fund, is early stage IP based investing.
Sounds pretty smart to me. Hi, everybody. I'm Michael Leventhal. I'm a partner at the law firm Holmes Weinberg, and my email is mleventhal@holmesweinberg.com. I won't spell it either, but I'm happy to throw out some cards afterwards. I do a lot of tech and entertainment work. I'm an outside general counsel. Essentially, that's often my role. And I've been doing digital media work for a really long time and was doing entertainment before that. And a lot of what I do is work with emerging companies, and I do kind of the nuts and bolts everyday stuff, and then a lot of strategic work that goes with it. Heavy emphasis in the augmented reality and virtual reality world.
Hi, I'm Steve Massour. I am a partner at Massour Griffiths. We are a venture law firm. We work with a lot of early stage companies in emerging tech areas, so that sounds pretty much like most of the people on the panel, which is fun. We have offices in New York, Los Angeles, and Boston, and we have been very, very involved in crypto recently. So we're representing, I've been working with tech companies for about 25 years, but just in the last few years, we've been working with we hijacked last year's panel to talk about crypto, and we convinced Victor to let us talk about crypto now, so it's exciting. And we are working with a bunch of exchanges, well, actually one exchange, crypto exchange, and then we have some funds and then a bunch of ICO companies. So I'm really excited to talk more about that and the relationship between token offerings and equity offerings, and what's going on in some of the foreign countries where token offerings are legal.
Great. Okay, before we dig into all that, we have to start at the beginning. So that leads Jason up, because Jason's going to tell us about how to pick the right project to develop before you start. Jason?
I don't know about
see,
how.
see if you have the magic sauce. Right?
Well, it's less about how to pick the right thing, just how important it is to pick the right thing, whether you're starting a company or trying to get a film financed or a company off the ground with crypto. However you finance the company, having something worth financing is a key part of the thing that so many people that I talk to seem to just sort of gloss over. The idea behind a movie seems to be the thing, but then just rushing into trying to get it financed without making sure that you have a team that's worth financing, a project, a script that's solid enough to be shot. All of the work that goes in before investors can legitimately consider it is a crucial part of it. And as we were talking about what to talk about on this panel, that was the thing that popped in my head, that so frequently we just rush to how to get it financed rather than should we get it financed in the first place. One last thing on that is, separate from film, if you're starting a company, understanding the size of the market and how much money you need to raise and how you're going to make money and exits, it's a really important thing to have firmly in mind, because the investors themselves are going to ask you all those questions. And if you don't know exactly what you're doing and why, they're going to find out very quickly and say, thanks for your time, but we're pissed that you wasted our time. Like, go figure that out and don't call us again. Maybe you can speak more to that, Brett.
Yeah, I think absolutely, following on to everything that Jason said, it's so important to understand, as a private equity investor or venture capitalist or even an angel investor, it's all about the exit. It's all about, figuring out at what point do you have your at-risk capital coming back, and then what are your returns. And it is so key. I mean, there's so many parts, whether it's film financing or video games or just businesses in general. Yes, you need the idea and the product, whatever that product may be, and then of course you need the management team, so you need the people and the processes and the different systems. But at the end of the day, if you're undercapitalized, if you don't know, if you have all this great stuff but don't have the money to do it, then you've built the best mousetrap and have no way to sell it. And that ongoing revenue and that ability to self-finance and be less reliant on outside money is key, because the best time to go out and raise money is when you don't need it. right? And so it's when you really need it, and when folks like myself see blood in the water, and they get the, sort of, you really get, worked over a bit. And so my advice obviously would be focus, especially on the financing, because at the end of the day, even if you put everything else and it was all, just the best of the best, if you don't have the money in place, you're just not going to go anywhere.
Talk to us about matching up the kind of project or company it is to the right kind of financing at each stage, because that's important for everybody to understand. You've heard him now say that your exit is what's key. I've been trying to tell people they need their exit strategy on day one for 15 years, and finally somebody else is saying it. Because your investor, no matter what level it is, cares how he or she's or their fund is going to make any money. So you need to start at the end, and that means you have to match the kind of investor you're talking to the kind of project and the kind of exit that'll make them interested.
And it's been interesting, like in the last 10, 15 years since the tech bubble burst, exits have been mostly sales to other companies, and there haven't been other kinds of exits. And to me, that's sort of something of a market distortion, because there should be other ways to exit. Maybe growing a bigger company like Facebook. There hasn't been an exit at Facebook. There was a lot of people who made money through the IPO of Facebook, so maybe an IPO, that market was kind of shut off. And that's what's exciting about crypto for me, is that it creates another exit strategy.
Yeah.
I think another aspect of that is understanding how investors invest, and maybe Brett can jump into this from his perspective, both from managing a family office and also managing money on behalf of other people. But on the film side, Slated, for example, has 2,100 accredited investors on the platform. They're looking for projects at different stages, and very few of them are looking for projects at any stage. So if it's just a producer with a script, some people will come in early and invest at that stage. Others are looking to come in much later, like when the movie is about to go into production, when everything has been decided, as many unknowns have been removed as possible. And then there's still others that'll come in when a project is in trouble midway through and make a loan, or as you put it, be able to work over a project. Different investors are looking for different things, and knowing who you're talking to and what their process is an important part of that.
And it's so hard. I mean, on a recent film thing that we worked on, it was actually a Kurt Vonnegut book. So you would expect that a lot of people would be interested in funding that, but it actually took 10 years because they weren't able to get the rights. And so, investors are also going to be looking for, what is it that they're investing in? I mean, do you have the rights for what you're doing? And that applies to tech companies that have hired outside developers and haven't necessarily secured the rights to the product that they've made.
Right. So the one thing I'd add to this, I think a lot of focus, and appropriately so, on finding the finance and what do the investors want and so forth. But it's a two-way street. And on the company side, you need to think about who the right investors are for your company at different stages. So it's not just what size check can someone write, but what other value do they bring? What sort of network do they open up? How do they help my company at this stage of my company's growth? Because just like some money is not appropriate, or some investors are not interested in early stage, or they don't do pre-IPO or whatever, you have to be thinking about at different stages what's the right financing and who's the right investor to bring that money to the table.
Right. There is an entire narrative that starts at the very beginning, and your point, people talk about smart money and dumb money, and smart money is infinitely preferable because it comes with the ability to do other things, to open up networks, to bring in other partners, to maybe bring in expertise. Dumb money is generally better than no money, but not even always. And it's infinitely preferable to have the right partners in place.
And I think to hop on both those points, I think for the longest time, investing was really opaque. You didn't really know what they were looking for. A lot of these concepts maybe weren't as mainstream, but then you have ironically a show like Shark Tank, right? And you literally get to see it's like being in front of something. There is now, of course, it's productionalized and not exactly what you would see in a normal going to a firm, but it's the same concepts that were just mentioned here. Each one of those sharks has different things they can bring to the table, right? One was, I think, is huge on QVC, can maybe bring that channel. Damon John is like huge, with this, or Mark Cuban has that, and so not only when you get multiple offers, that's when that really comes into play, saying, well, who's going to do the most for me? Who has the most network? Who can provide that follow-up funding? And so I think that's a great point, and I think Shark Tank, although great for entertainment value, is also great for educational purposes, because you really now get to see, hey, here's conceptually what I should be doing, or what that process is. I got to pitch very quickly. I got to get my points across in a concise manner. I got to figure out what the exit points are. I want to understand from them what they're going to be bringing to the table. So, what's the right fit and what's the right money? If you have an idea and you say, oh, it's worth $10 billion and I'll give you 1% of the company, you'll get laughed no matter how great an idea it is, right?
Yeah, and
so
what can you build without the money? What can you sell without the money? I mean, if you could actually start to work on selling the product, I mean, I think there's a lot of people who spend a lot of time raising money, and they could be selling their product, and they would actually learn a lot about the market that they're selling into, and then they'll know who the right money is at that point.
Right, and that right now is the most expensive money you're ever going to have to purchase, because your company is worth the least amount. So to echo what Steve's saying, the more that you can bootstrap. Sometimes you can't bootstrap because you got to get out into the market yesterday, and then you just got to go get the money. But if you don't have that situation, the more that you can bootstrap, the more value you're showing to your potential investors, the more interested your investors will be, and also the better the deal you're going to be able to strike.
Yeah, I think it's also important. It's not only smart money versus dumb money. What I tell clients, and why I think some companies want to talk to different investors, is they want to be partners with those particular investors, and for a company raising money, you have to think about, I'm going to be reporting to this person. They might have a board seat. If they don't have a board seat, they're still an investor that I have to answer to. I'm taking their money and I'm going to go do something with it. So when you are taking that money, you want to know, hey, I'm going for a ride with this person, and do I want to be in the car with them? Mm-hmm. And if the answer is no, because the signs tell you that early on, you need to make the call. You might need the money, and you take the money. But if you have a choice, maybe you don't, because you can already see the writing on the wall of how they're going to act. I just did this. We're negotiating a Series B financing, and the lead investor was being a total bully the entire time, through the term sheet, through the investment financing or the investment docs, and ultimately the board said, you know what, enough is enough. You're out.
Yeah, and I mean, you got to give them this money back. I mean, it's not free money. They don't just invest and then they're your partner for life. I mean, they want to get out, and you have to think about how are you going to make the money to give them their money back.
Yeah,
Think about the pressure they're going to be bringing to bear to get that money back out of you. It's considerable.
The thing to remember is, as soon as you take significant professional money, they control your exit. They can exit you, they can pressure you to exit before you're ready, and you get, 5% of what you meant to build this company on. And the minute you take their money, you can't get divorced. You don't get to say, I don't like it anymore, I'm going home. Right. So there's this notion of bootstrapping. The farther you can bootstrap and the less control you can lose to outside money, the better off you are to control your own future. Because they only have to show up for board meetings. You have to do it 70 hours a week.
And the investors also want to know that you've sweated blood over this thing. It helps to show, that the bootstrapping helps in a lot.
It's just so important.
Yeah. So.
All right. Greg, you said you saw some new financing trends recently for digital media companies, particularly short form. Can you tell us about that? That was interesting.
Yeah, I mean, we were talking about some of the topics that we could talk about here, and one of the things that I've been seeing, it's actually negative, and the negative has been that the various clients that I've represented that have focused on digital short form, scripted digital short form, have had a real tough time making a go at it. I think if you look back a couple of years ago, YouTube launched its channel initiative where they basically funded $5 million per channel to go do a bunch of short form content. Some of it was scripted, some of it wasn't. Some of it was really high quality scripted content. But nothing really took off from there, and they actually shifted strategy. They shifted to YouTube Red, which is more of television length style content, and to their platform, their cable platform initiative. Same thing with Netflix. Netflix is a digital leader, television style content. So what I've seen is essentially all of the companies that have been focusing on short form digital scripted content have been having a rough go. And where I've seen success is those companies that can make a shift. And the shift has been going to traditional television length series. There's a lot of buyers for that, and it has been facilitating the digital or traditional production market significantly. Some people are highly in favor of it because it gives a great shot to get productions done. Some people don't like it because buyers like Netflix basically monopolize the purchase and distribution model, and then you really only are selling at essentially cost plus. But the other path is finding different ways to structure those short form projects. So you might do a scripted, reality based kind of project. So one of my clients did literally a feature length film, but filmed via Snapchat, and it was picked up really great coverage. They had an influencer lead it, and so I thought that was really unique. I haven't seen anyone else do it. It was genre, it was horror, but it was really unique, and it got a lot of user views. Then they ultimately assembled the project and redistributed it as a feature-length film. So that was, I thought, very interesting. And if you look across the market, like I said, YouTube, Verizon's Go 90, not going to be there. So the path to financing not only these projects but the companies, in particular is going to require them to make a shift in my view, and I'm seeing it.
And look at your reversion rights for Verizon Go 90.
Sure.
I understand the premise that you just described, and this is not my business. I do startups, creating a fund myself. But what was it? Jeffrey Katzenberg just released information,
Yes.
800 million for
Yes.
15-minute shows.
Yes.
High value production dollars for
Yes.
15 minutes. What is his strategy?
That's a great point. I don't know, because to be honest with you, I don't believe that the advertising dollars are there.
He's talking about 5 million an episode.
Yeah, I don't think the advertising dollars are there to satisfy that production budget on that type of project. There's not enough time, and today at least the economics are not there. So I don't know the exact strategy. I know he wants to create high quality short form scripted digital content. My guess is that it will be consolidated and packaged into series length projects over time, but in the short form, there are no economics there.
You do episodic, you do 8 episodes at 5 million each for 15 minutes per episode.
I don't think it was 5 million each per episode. My understanding from reading those articles was that it was Netflix budgets. So if you think about it on an hour basis, so if Netflix is spending $5 million per episode for an hour, it's that. So think if you have a 10-minute episode, it would be a fifth of that or a sixth of that per hour.
But it
Still
hasn't
expensive.
worked.
Very
expensive. Yeah.
So what you're saying is, not only do we have to look at the funding, the exit, we have to look at morphing the content to what the distribution channels will allow, and whether the production cost actually makes those distribution channels work.
Yeah, and if you can sustain a business
Right.
In that production model,
Right.
that production revenue
Yeah,
model.
we're not talking about just projects, but a business that goes on and on and on. A project can get you one win and no wealth. You want a company that can actually create wealth.
But the point of what Greg was saying at the outset is that the value of the content that you're producing for whatever the budget is, it could be $10,000 per 10 minute, or it could be $1 million per 10 minutes. But if the value of the content itself doesn't grow, to say nothing about getting smaller, then the investment you've made is worth nothing. So if Katzenberg spends even 100 of his $800 million on this particular thing, and ends up with 100, whatever the math works out to, but ends up with a library of content that YouTube pays some amount for, over time, it's basically, it's not going to increase in value because you can't play it anywhere else. And I think you'd have to have a whole ecosystem grow up around this. I think if you give it the benefit of the doubt, I think the idea is that younger viewers, like my daughter's 13, she loves short form content, which is to say she watches everything on her phone. She'll watch a movie on her phone, she'll watch a 2-minute video on her phone, and everything in between. And so Katzenberg, I assume, and Meg Whitman, who's involved in that effort, they assume that that's only going to increase or at least stay stable. So let's create content specifically for them. And yet, like we've talked about, I too don't see the value there.
And it hasn't, my point was it hasn't been sustainable. So and I knew that the audience on our panels, on this panel in particular, is not only tech, and it's in many cases entertainment producers or folks that are looking to start companies in that space, and that's just the trend that I've been seeing.
I'm seeing, I hear everything from the AR, VR perspective, because that's what I spend much of my day. And this is exactly the issue that's happening there, which is people are trying to create content for a platform that largely doesn't exist yet. It's pretty tough to get funded when no one has any idea how you're actually going to be able to distribute your content and how you're going to make money off of it.
We could apply the principles we talked about before to this. In AR and VR, you're going to do a lot better if you're selling to the brands installation projects. Mm-hmm. And I think that's really the flaw in Katzenberg's. He's building it and hoping they'll come. I think it's better to just sort of go to what we know that people want.
I was laughing because I have a couple of VR clients, and we always joke. There's literally, like, I don't know the numbers, but they're very small of the people that actually own a sophisticated VR headset. It's sub 500,000 or maybe around there worldwide.
And then what's the percentage of them who've actually put it on in the last month?
Exactly. Exactly.
But that doesn't define VR for me. Like, that's just one part of VR. You've also got location-based VR, which is a much bigger market.
Absolutely, yeah. Absolutely. But in the device-based market,
totally.
the market is so small.
With the install base for PlayStation and Xbox, you have a potential to send over a hardware headset that could eventually work with this legacy system and tap into a library that could be repurposed, or a new library that could exist overnight, because the units are there, Xbox and PlayStation, represent an
Yeah, there is something missing, though. I mean, you have to admit, there's, to his point, there's something missing. Like people are not buying these. Is that because the killer, content hasn't happened yet? What's the problem?
I think you're right. The video game platforms are the kind of best bet, because the computer platforms are not an easy path for the normal consumer. You need $1,000 plus computer. Right. You need the $500 headset. It's not realistic.
There's no iPod for this.
Just think of the form factor. I have 4 kids. Three of them are teenagers. One of them is 12. So getting into those teenage years, and I invest into video games. We have Xboxes and Wii and this and that. We have zero VR, and not because they don't want it, but it's the form factor. Them nor any of their friends will lug over this big headset and the computer and the wires and this, that, and the other. If it gets down to Google Glass, if it's like Jason's glasses or your glasses,
I bet they'd all go to Void, though.
Yeah.
Well,
Microsoft bought
right.
a bunch of education companies for a reason. It bought a gaming company called Minecraft. It bought LinkedIn because of its education output. It bought this whole opportunity to say, we're not only create productivity software called, the Microsoft Suite, we also have a suite of authoring tools. We have a library of professional services tools, and we're buying. Well, I understand I do not own Microsoft, and I don't have a mouse in my pocket. There's no we in the royal sense. But the notion of it is, there's a tremendous opportunity of legacy. And the big guys always win because they literally have enough cash flow to buy into where people are already at. I personally believe, like the gentleman said, where are the hits? I think the big hits are going to come from consumer-driven IPs versus what some label has today. Because if we look at consumers have the means to create cool stuff. They do cosplay. They make fan-driven products. AR and VR represents a new medium to tell stories and to get distributed and to use authoring tools and to really play in a space that cinema has held our attention.
Yeah,
I'm going to pull us back to financing, okay? That's what we're here for. All right. Anybody want to wrap that up?
Yeah, just to say, just on the AR VR front, just for a second, I'm a true believer. I just think that we're in that spiral where we're in the chicken and egg, and we need, the content's going to get better, the form factor is going to get better, the assets are being created now, films are being shot with an extra camera or extra attention to the digital assets so that those can be used in other platforms. So this is a thing that will definitely happen. It's going to be very, very large. But right now, if you're taking in funding for an AR/VR project right now, you better be able to articulate the ROI on that, and it's pretty tough to do at the moment.
I think it's easy to do it if you're doing a brand activation, though. And,
Yes.
and we're doing, I think, 3. I mean, I never thought I'd be in the real estate business, but I call it the real estate play in VR.
Yes.
We're doing 3 of those projects.
I have a few
one of
of
them's
those
funded by a city. I mean, it's incredible how much of that stuff's
Yeah,
getting built, and it's easy to do the brand activations there. And again, applying our earlier principles, you can just sell a brand on doing a VR activation in one of those spaces, and then you've proven your market.
Right. So what you've got now is a shifting investment world where there's more and more kinds of funding available, but they're becoming more and more specific. What kind of investors will fund what kind of projects and companies and at what stage. And we're in one of those loops where the technology is changing ahead of the market. So if you're producing for the technology, so if you're either producing the technology or the content that goes on the technology, you have to be anticipating where that technology is going to go and at the timing, the market timing, for when it will actually have enough critical mass to make your point, to get your funding. Because getting your funding and then running out of capital is actually the worst thing that can happen to you. Better that you wait longer, or you morph, or you pivot to another platform and wait for the market to catch up. Being first on a lot of things is just having, you're the pioneers with the arrows in your back. Sometimes you can wait a little while. So now we have other forms of funding. So we're not talking about crowdfunding. You know about crowdfunding. There's lots of panels about crowdfunding in this show. But not crowdfunding, but token funding built on the blockchain. We have a brand new technology. I'm going to who did I decide? Michael's going to give us 2 sentences on the blockchain and coins and tokens, just so we all have the language down. Do it.
Which means, yeah, right, or no
Michael.
one will know. All right. So, and if you guys already understand this, permit me anyway, but blockchain is basically, it's a distributed ledger. That means it's a distributed database. It means everything in the network, everyone in the network can see what's on each of these databases. They're all in nodes. The databases essentially have to agree with each other in order for them to be presumed to be valid. And what that implies, theoretically, is that they're not hackable. So you get a secure, instantly recognizable, instantly verifiable database, and that has applications that are really going to transform the world over the next 5 to 10 years. So, how'd I do?
Pretty
That was
good.
good.
The way-
That was
Do
good.
you want to emphasize,
All right.
because so many people associate cryptocurrencies
Yeah.
versus
Right.
blockchain, which they're
Yeah,
really
I think blockchain, the one website is to the internet as Bitcoin is to blockchain.
Right. And so then the next definition that Joey asked me to bring up was cryptocurrency, and I was thinking about it, and I went and I looked it up to see what like Investopedia said about
Yes,
it and things like
right.
that. And it's really interesting because I think in one of the last panels, somebody said cryptocurrency isn't a currency. And
Yes.
that is something that that people talk about all the time. So that's the first question: is it really a currency? And the idea behind cryptocurrency is it's based on the blockchain technology. It's based on the cryptography in blockchain, and it allows you to have a distributed digital financial asset or currency. There's no central authority, and the kind of the dominant metaphor for what those assets are tokens. And there's a couple of different kinds of tokens, and this matters hugely, especially to all the securities attorneys on the panel, whether it's a securities token or a utility token. So that's a quick overview of that. But that's the key point that was just made was crypto is just one application of blockchain. It is an important one, but it's just one.
It's the first one.
Yeah.
The two things, so I'm not at all an expert. I've done enough reading to be able to have a conversation about this, but the two key things that really resonated for me in this space are that cryptocurrencies and the blockchain are important because they're decentralized, so there's no one company or one government that is in charge of the thing. And then the way transactions happen they're enabled to be trustless, which is to say that you and I don't have to know each other at all in order to transact through this technology for a variety of reasons, one of which is the cryptography that's going into recording the transaction itself. And so a lot of the technology that's getting built up around that is to enable us who've never met, we don't know each other's name even, all we know is you have a thing that I want to buy, and we've been enabled through the internet or whatever to have this transaction to happen not in dollars but in whatever this token that we're within the environment that we're making the transaction. So now we're back to the tokens that you're talking about where this stuff is happening.
Yeah.
But I think what's exciting about it is the liquidity. I mean, liquidity is what's scaring the SEC, and the liquidity is why it's exciting. That's what it's about. That's like if you can, and also the fact that it's not an equity purchase.
Or is
Okay,
it?
but
Or is it?
in the last panel, somebody, just before us, somebody said, well, there is no liquidity.
Yeah.
Which is just not true.
Yeah, I'm glad somebody called
not
that
true,
out.
right.
Is that, just kind of to digress for a second, when you talk about funding, one of the things that I think scares the crap out of the VC industry is if you think about like the venture capital model of the higher level VC funds, they build a fund, and they take in a bunch of investment, and then they invest in a bunch of companies, and that money is sitting there until each company has an exit, and nobody who has put money into that fund gets any money out until the exits start happening, and that could be 5 to 10 year time horizon. In crypto, or in token sales, those things are fungible now. You could invest today and get out tomorrow, and so that gives you flexibility and liquidity that the VC industry cannot match.
That's right.
This
The
gets-
VCs are actually really threatened by the whole notion of initial coin offerings,
Yeah.
because nobody is talking about venture. They're talking about ICOs now.
Yeah.
Silicon Valley, it's just like I've never seen more FOMO in my entire life. I mean, they're all running toward it. They're
So-
all trying to form crypto funds.
Right.
They're the ones that have funds are, don't know what to do, don't know how to get out of the obligation to get that money invested so they can move on.
And so just to make it worse for you, not only is it a brand new technology, the blockchain, very early stage technology, the complexity of doing an initial coin offering to raise money is complicated, particularly in the US, by the government intervention trying to hold on to the horse that's already raging out of the saddle, out of the stable, right? So you got the cheat sheet.
I got the cheat sheet.
So do the cheat sheet
and I
for
needed
them.
the cheat sheet to remember all of these things. So the idea is, so we suddenly have crypto, and we have initial coin offerings. Which governmental agencies want to try to regulate, have some control over that? So the SEC says it's a security, so it's got to be regulated by the Securities and Exchange Commission. The Commodity Futures Trading Commission says it's a commodity, and that means it's an asset class that has to be taxed. The IRS says it's revenue, so they want to tax it. FinCEN says it's money, which could potentially fund terrorism. So companies moving money need licenses to transact like banks. The FTC is interested in false advertising claims. Each state has their own securities laws, some more liberal than others. And that's just in the United States. So
even the Fed, like the Fed has talked about doing a Fed coin, right, to sort of compete and have.
Right. So there's uncertainty.
Right.
It's uncertainty.
My favorite coin is Howie Coin. Howie Coin is it's a website that the SEC put out to show you what a fraudulent ICO looks like. It's actually definitely worth looking at. It's beautiful.
Now, there's a history.
I just want to make
There's
one. I just want to make one comment because so I'm a securities lawyer, and every 80 years or so, something exciting happens in the securities world. give or take a few years. Right, exactly. I just
And this
see you
is
again.
your year,
Right, see you again in
Jennifer.
100 years. But in any event, so I think it's true. The regulators, these various regulations, everyone's trying to figure out how to capture this thing, how to regulate it, how to prevent fraud, how to do all those things. And we can certainly make light of it, where we know something about it, maybe more than some other people. But the truth is, there's a lot of misinformation out there. Sure. There are a lot of scams out there. There are a lot of people who want to make money off of your business and sort of exploit your business by doing ICOs and other sorts of fundraising methods that really aren't in compliance with law at all, or are fraudulent, or is so far out of bounds that you're going to lose your project. So yes, it's exciting, and yes, there are new avenues opening up. But you really need to be careful, and you really need to be cautious and to some degree conservative, because we don't know what the result is going to be, as they say, when the tide goes out, who's going to have a swimsuit on, right? And you want to make sure you've got one on. So.
And that goes even to the types of tokens that I mentioned earlier. Like, if you're trying to raise money and you say, this is a utility token, and
only if you can
classified
prove
as a
it.
security, and then all of a sudden now you're in a heap of trouble.
Yeah.
Right.
So
This Jennifer's point is really important, because in the last 6 or 7 months, the world has been flooded by what I call carpetbaggers. We're at the gold rush here, and the carpetbaggers showed up really fast, and not only can you not get on their schedule for them to advise you how to start your company, these are consultants and attorneys and any other kind of service provider who's got a website up, right? But they charge you enormous amounts of money for the basic advice, and you have to wait 2 or 3 months, which may mean the market changes while you're waiting, to get that advice. So when we started Guardium as a crypto on top of Guardian Circle, I said to my client, we need at least $250,000 to play.
Yeah.
Just to get on the stage to know what we're doing and put a white paper up and get it started so we can raise the $10 million that we want, right? And then you've got to find the right U.S. attorneys and offshore attorneys, and the list of what you have to learn is legion.
Yeah.
Right? So don't think that it's simple to go do a coin offering, a token raise.
And some of the most trustworthy ones were the least trustworthy ones. Like like the first carpetbaggers were the major venture law firms, and they made a huge amount of money on it. The SEC's definitely hunting them right now. It's
right.
Yeah, it's interesting.
There's
I keep hearing the term democratization, and it's something that kind of harkens back to our early days of the web when we heard that, and the idea that blockchain and crypto is going to really lead to a democratization of all sorts of things. And I think that in the big picture that's probably true, but if it takes you $250,000 or $500,000 to get in the door, that's not a lot of democratization, so we're going to have to solve that.
Well, you could maybe build your first project with that instead.
Yeah.
You know, or use it as your seed capital. That's seed capital. If you can find 250 to give to the consultants, right? Don't mean to raise my hand. But, not me. It's a problem. And Jennifer, you had something to say about using your initial coin offering for more than a funding mechanism, deeply connecting it to the overall strategy of the business.
So you know, I think other people on the panel are doing a lot of work with ICOs and lots of different businesses and lots of different aspects. So I think that there's this idea that you can sort of ICO any kind of business, you know, sort of immediately from the beginning, and that may be true. But you know, in addition to what Michael and others said about how the blockchain works, I mean, these tokens are designed, I guess, to ultimately permit users to use software that's being built on the blockchain. So to use applications, to use, you know, any kind of contract or other sort of, you know, transaction that's going on the blockchain. And so the SEC has said, you know, is it a application that you can use today? If I give you this token or this ticket, can you ride today, or you're only going to ride in the future if things work out? So the question is really, what is the purpose of the token that you're selling, right? And does it have a purpose related to the business that you're forming, or the project, or the film, or whatever it is? And so I think it makes a whole lot of sense in a way to sell tokens, or sell, you can think of them as tickets, or however you want to look at it, for a project that's already been developed and that the buyer of the token can utilize, because that represents a fundamental value associated with that token or that ticket. Whereas, you know, issuing tokens that have no usability in your business model really makes no sense. And that really starts to look, I think, much more like a security. So you have to say, I mean, you have to ask yourself and your advisors, is this the right business to issue an ICO? Does this really make sense? Is this the way we should raise money? What is the purpose of this ICO besides representing an economic interest in my project? And we could have a whole conversation about what the economics of tokenization is, and you can tokenize a film and you can do all that. But as a startup company, you know, again, sort of susceptible to, you know, all kinds of advice and, you know, all sorts of information. Some of it's good and some of it isn't. You really have to ask yourself, does my business lend itself to a token? What is the purpose of this token with relation to developing users and having people on my platform?
Most of the stuff I've seen talks about ways to use the token because they had to figure out a way to use the token, not because not because the business required a token to run, or it enhanced or solved some problem by applying the token. The token is, you know, just sort of an afterthought. What the forethought is, people love coins. They want to put money into this stuff. I shouldn't take some of that stuff.
Well, and the other forethought is, I don't want to go to prison, so I better figure out which is the right way to do this.
Well, but if you don't have a real use for the token, and the token is just a sham, then you are going to go to prison.
Right. Yeah.
So there was digital money before. It was in video games, right? When you bought shields and swords and stuff with, there has been digital coin before in various, but
Not before, now.
It still exists.
no, I didn't mean it was gone.
Brett's company, yeah.
But in fact, there's a history of this, but it was in a closed ecosystem.
Right.
So if you're going to do what we're calling a token, a utility token, the utility is that the coin is actually used, the token is used within the ecosystem of some application you've already developed. If you're just putting a coin offering up in order to raise money, that's like stock manipulation. Hi, I'm a Ponzi scheme who's got stock here, and you invest in this and it'll pop right up. Okay, so that's when all those long list of government agencies come and talk to you.
Yes.
And there was a wonderful guy on the previous panel who kept saying, I don't want to be the case study for how the government got me. I have a business to build here.
You don't even want to win that lawsuit because
It
you're
just
in
wasn't having it.
Yeah.
Right.
You had a question. You had a couple times.
No, behind you.
No, behind you.
Pointing at me.
You had your turn, honey.
Michael, ask my question. Okay. I would like to discuss Goldman Sachs, Facebook, JP Morgan, and what's happening in their environment. And a book that's about to come out called Masters of Blockchain by Andrew Rollins.
Well, I don't know the book, and I don't know exactly what those organizations are doing in terms of the technology that they're building on the blockchain. But I will tell you that, and other people probably know this, that publicly Bank of America will say that they don't feel threatened by the blockchain. It's not something they're too concerned about. You know, they're sort of casually reviewing it. But I also happen to know that they're the biggest filer of blockchain patents in the United States.
Wow.
So, you know, so they're well.
Hiring blockchain engineers like at IBM.
Well, that's a good question. There's a big brain drain going on in terms of hiring, and so just to take a little sidestep there. So I spoke recently on a blockchain and crypto panel, and one of the things I talked about was that it's true that fundamentally the blockchain is not hackable because it's distributed, and you've got tens of thousands of rigs or nodes of computers around the world all verifying transactions, and that's good for sort of the fundamental, if you will, engine of the blockchain. But because there's such a brain drain and there's such a demand to build technologies, and everyone is producing white papers and everyone wants to draft code that will sit on the blockchain or transact with the blockchain, a lot of that sort of add-on technology is actually not very well coded, and it's extremely hackable. And if you look at all the hack stories about Bitcoin being hacked and other ICOs being hacked, so and so, it's all in third-party technology. And in fact, it's so delicate, if you will, that even big exchanges like Coinbase, they only keep a very small percentage of their actual coins in what they call hot wallets, which are available for trading. And the rest are literally wrapped in bubble wrap. They're sort of, physical wallets. They unplug them, they wrap them in bubble wrap, they code them with pictures. They don't even use numbers or code and store them anywhere. And they're all like in a vault somewhere. So, I mean, there's this technology that's changing the world, and, Bank of America thinks it's worth filing a patent every day. But, the biggest traders are still having to use bubble wrap to protect the coins. Right. But having said that, yes, big enterprises are getting into it, and there's a lot of question as to how they're going to perfect it and how they're going to protect it.
Well, I've seen a lot of activity at JP Morgan, and obviously we've seen what's happening with Goldman Sachs and Facebook.
But Jamie Dimon spent a year saying the cryptocurrency was hokum. He said whatever and all the time he was building his own coin.
I was going to say,
Right.
it was a little duplicitous because he would bash it. It would literally drop down, but meanwhile he's
Well, all these traders were buying in, and I think they're setting up their own exchange, and none of that is a secret.
Right.
Do you see at the time when companies will delist from, say, the NASDAQ or the New York Stock Exchange, and then relist in the form of a token offering?
I don't think that's really how it happens.
No.
I mean, it's new companies that will, it didn't even happen with NASDAQ, right? You didn't delist from the New York Stock Exchange to list on NASDAQ. What happened instead is that the tech stocks listed on NASDAQ instead of the New York Stock Exchange. So I think
Right.
that's what you'll see is the new companies will list in whatever the popular
Because
securities exchange
that's the
is.
fundamental thing, right? When you do an ICO, you're not selling even one share of the company. So if you are the
Right.
owner of the company and you do the ICO, there's a lot of economic activity happening over here, but the company is owned by you. So there's no need
Getting
to
listed
list at that
is
point.
difficult too. I mean, on any exchange, and the exchanges to a large degree, like what's happening now is that we're going from the earliest stage to normal people like us getting involved, and that's going to take a lot better software. So in November, all of the exchanges failed except for Binance. Binance didn't fail because Binance was programmed originally to do commodities. It was a commodity exchange in China, and they had I think $1 trillion
Valuation.
value of
Transaction
exchange transaction volume, exactly. And now the new exchanges are really a lot more bulletproof. An exchange like Kraken is just not going to survive.
Right, but that's the problem, is technology. Quantum computing kills blockchain.
Could.
I don't think we're going to go there. I'm not going to go there.
really.
That's too technical. Let's leave that
Well,
one.
I mean, you don't have, the 30-second version this is all secured cryptographically, and the idea behind a quantum computer is that you're doing so much computing so much faster that you can actually crack the cryptographic thing that's locking up those transactions. So I mean, I don't know how far away we are from an actual quantum computer, let alone a lot of them, but it's not that far.
So IBM is hiring a lot of software engineers in that space,
Yeah.
especially for cryptocurrency. So if you look at the human resources, from a human resources perspective on a lot of these coin offerings or a lot of the banks that you see, think of what their approaches are from those eyes.
Take advantage now is what their approach is.
Yeah.
I mean, it's here to stay.
It's
Yeah, and-
definitely here to stay, but how it shakes out,
It's
very,
really early.
very
I mean,
early.
it's super early. Like
Right.
like when we talk about blockchain, it's just a way to do something, and there's a bunch of different ways to do blockchain, and there's also competing technologies to blockchain. So like Hashgraph is a competing technology to blockchain, and there's a bunch of others, and we're really early. I mean, you gotta and waiting. I don't think waiting is the right thing. I think get in and do something, but do something real. You know, like see how you can use this technology for whatever it is that you're working on.
VR and AR.
Yeah.
We've been offered tokens for film finance. We produced 27 movies, and it's all feature films. And now we're being offered by Chinese companies that they want to pay us in tokens to participate in film finance.
You're bringing up an interesting point.
That's what we call it.
When you walk into the crypto world and you're building on blockchain and dealing with tokens of any sort, you're in the international world. You can't, one thing, that list that,
Yeah.
our cheat sheet of all the government agencies calling it something different means that in the company that I'm working with, we simply won't allow US investors because it's too risky. Right? So all of the investors in our raise have to be international, right? We don't even take accredited U.S.
Well,
investors.
it's interesting because from a theoretical legal perspective, it's like a legal theory exam. I mean, legal law is based mostly territorially. And so the laws that Michael described are all U.S. territory laws, federal, not even talking about the state laws that apply, not talking about the EU laws, not talking about the laws in China. And this is just, it's like the internet was small by comparison to this. You only had one set of laws affected. This is kind of like all the rest of the laws are affected by the concept of non-territoriality. It's
Yes.
really
Yeah.
interesting.
This is the disruption that makes a global village, because if you can trade globally, it's like the Silk Road, right?
Yeah. Well, and
when
especially-
you can trade, you go on your computer and trade international currency for this and buy this from here and so on.
But this could be a Waterloo moment for the technology industry in the U.S. because
Yeah.
we're literally scaring innovation outside the U.S. right
Absolutely. Absolutely.
But it's not just that you can trade globally, it's that you can trade globally without the use of the established international
money.
banking structure
Right.
or
Right.
governmental taxing agencies. And that's what I think is that's disruptive.
That is, it's wonderful. All right. Other questions? Here.
So in relation to that, that risk factor, especially when you're talking about service providers that are involved in a project. So it seems like there's just, at this present time, it's too risky to go down this path to fund arts and entertainment because there's so many unknowns, and those that are involved in the fund and then any service providers involved in that project could also be at risk. And the example I bring up is, so I wear many hats, and one of them is
The question is they become service providers. So I don't think you would create a new entertainment content and then just launch a coin for it in the absence of a platform that does that. And those platforms already exist, and there's going to be more.
Yeah. So if without due diligence and really understanding what you're getting yourself into. So for example, I was hired to do content marketing for a blockchain startup. And once they really started understanding the legal ramifications of this coin that they were making, they decided to go through and get traditional funding. And I saw at the same time you know, there was a company where the founders were literally caught and arrested before they're getting on a plane to leave the country, and they threw their content marketers under the bus, and that's what they essentially the same kind of service I provided this blockchain company. They said, well, they're the ones who wrote it, and they're the ones who were guilty for it. You know, which obviously doesn't.
It's not going to work.
But, I mean,
To get a nice try.
Right, exactly.
That's an easy
but
bar,
I mean, when I posed this question at the blockchain summit in Irvine, they said, well, you need to start talking to your lawyer a little bit more about your contract, and this whole ball of wax that, you know, if you're a contractor, which is usually the case on most films, everybody's freelance. I mean, does that open up even more risk, not even just the person making the movie, but actually the people involved in that project? Do you think that there's potential for legal fallback on the entire project and anybody involved in that team?
Well, I mean, I'll take it very topically because I'm sure
It's
there's
a
lot
criminal
better-
conspiracy to make a movie.
I mean, this is when you think of the maturity curve on this, like we're so far on that side where everybody's trying to figure out. So it truly is wild, wild west, right?
Yeah.
And I think, you know, you could ask each one of us, in fact, everyone in the room, say, hey, give me one story. And it'd be very rare that it'd be, oh, this is the exact same story, because there's the lack of consistency, across the entire marketplace and globally is really what's driving that, right? And I think, showing just in the U.S., oh, here's 8 different governmental agencies that all are, trying to corner the market on who's responsible for it, right? And that's going on around the globe, and that's just federal level, not necessarily even state or province or and so I think there's going to be, it's just like any other time in history or in industry where you're in that Wild West, very immature part of that curve, where there's going to be, there's going to be winners and there's going to be a lot of losers. And what these government agencies are trying to do is try to protect and try to minimize and mitigate the risk for the most number of people that are on that losing side of the scales as possible.
So go ahead.
That's a nice way to put it.
I was just going to say, fundamentally, for a company or for a project, the sad state of affairs is that you can raise money less expensively on Kickstarter,
Yes.
selling, giving people T-shirts and a copy of the DVD, than you can doing a crowd-based securities offering or an ICO. That's just the fact, and it sucks.
Thank you.
And
no, but it's true. It's too early.
True. And there are multiple reasons for it. A big part of it is the SEC, but so it's not that advisors are trying to make a go at this and steal anybody's money. The stuff is very, very complicated. In the crowd-based, and I know this is not about that, but in the crowd-based area, it's very complex. They tried to suggest that it's going to be easy. You could sell securities on the internet, on your website, up to $1 million, all this crap. It's very expensive and very complicated. And then you shift it over to ICOs, it's even way more complicated than that because of the multiple complexities of, is it a security, is it not a security, is it utility, is it not a utility? So that's just the state of affairs, and it's sad that you can put up a project or your product on Kickstarter and people that are not accredited investors can give you $100 or more for a T-shirt, but they can't give you $100 to buy your security. But that's just it. It is what it is. And so when companies are doing this, you just have to know you need advisors, you need financial advisors, you need legal advisors, you need accountants to properly structure any one of these particular transactions, unfortunately. And they're going to help you. Some are going to be more expensive than others, but you won't do it otherwise.
The price is already going down too. I mean, give it a year. It's already gone from $650 to 250, in 1 year.
And I also think Greg touched briefly on the the dichotomy between the securities tokens and the utility token, and I think there are some pretty fairly well understood situations in which it's a utility token. If you're selling somebody, I think we were talking in the last panel, a download of, you give us, $20, and when the thing comes out, you get a download of the film or something like that. I'll leave it to the securities folks on the panel to opine, but that starts to be somewhat of a straightforward transaction that looks a lot like a utility token, and we may not be there today in terms of people being able to say, okay, I feel comfortable with that without spending $250,000 on a lawyer, but I think we're going to get there fairly soon, that there are going to be some fairly established things that you can do that are not going to cause you trouble with the SEC.
Yes, it's early yet. It's just early.
Yeah.
Well, so I mean, the thing I would add to that is, it's certainly the quote Wild West in terms of the technology and the avenues that are opening, and sort of the movement away from a centralized system, so on and so forth. Really exciting, lots of international activity, lots of disruption. The truth is, though, there's lots of regulations, right? There's SEC regulations, there's tax regulations, there's, SINFIN, tons of regulations. So you have to take kind of a level-headed look and say, well, it's not that there aren't regulations, it's not that this is an unregulated area, it's that there are a lot of people who refuse to acknowledge that there are regulations that might apply to these activities, right? So you have to say, how would these regulations apply? And if we applied them, what would it mean about my activities? And that's really kind of what the SEC is doing, and SINFIN and all these other, bodies are trying to say, look, this is not a completely unregulated matter. We all live in a world with laws, and these laws are going to apply. They may not be a perfect application, but you can't just act as if they don't exist. So
I think we should get ahead of the laws, though. I mean, I don't think that these things are like what these agencies were all created to regulate. And I think it's myopic for the SEC to say that each one is a security, and it's wrong for FinCEN to say that the money transmitter laws apply to all of them.
Right, but I would look at, for example, there was a subpoena issued to Coinbase recently, right? So all these people are trading cryptocurrencies on Coinbase. There's something, they have value. It's certainly valuable to persons buying and selling it, but people are not paying taxes on it. I mean, I'm not a big fan of paying taxes, but how can you say, well, it's a cryptocurrency, it's not subject to taxation? Like, this is property that can never be taxed because, I don't know why, because the IRS code doesn't refer to cryptocurrency. Right. I mean, I think to go back to your question, which is, I'm sort of an innocent bystander, I've been hired to do something on a project, like, what's my liability here? I mean, I don't have an exact answer there, but I will say that the regulators are really looking for the bad people, to sort of say it that way, who are really creating the outlier problems and the real fraud problems and the real flagrant abuse problems. And I think, at least in a securities world, if you're not actually a controlling person of an issuer, you probably have no personal
That's a really good point. I mean, it's there's not a securities regulator for each fraudster, right?
I mean, I don't think this may be an imperfect analogy, but if Bernie Madoff raised a bunch of money fraudulently and then paid somebody who then paid you to deliver a service, the original money is not coming after you because you provided your service, right? They're going after Madoff, who did the fraud at the outset. And I'm not saying crypto is fraud. I'm just saying worrying too much about second and third, levels down is probably being a little more paranoid than you need to be. Be careful, but I don't think paranoia is warranted.
There's a lot of red flags when I see
Sure.
proposals come across and no.
Yeah, I guess how close are you to the raise?
Well,
that's an interesting point you raise, because that's a problem for all of us too. Is that it used to be so easy. If they were building a product and you could do work on their project, but now you kind of have to look at, am I working with criminals or not? And it's a complicated place.
Well, PR companies and the media companies are actually heavily involved in that because they create the messaging. They
Yeah.
turn around and hire the people. Like I was hired through a PR media company because they do all the messaging to the press, and then they also contract those who actually can write the white paper and do it effectively. In addition to me, who's writing the content marketing on that side and doing the education part to the target audience
I
for
agree
that
with
for
that
that
point
service
there,
sale.
but the point about you create a token because it matches the need for the product. The person who's creating the service in the beginning before they brought it on thinking, there should actually be a use case for the token before you say give the proper messaging. So there's a decoupling of.
Well, that's also the role
Okay,
of the
hold
PR
on.
marketing.
Excuse me, we're in the weeds now.
Sorry.
Yes?
Different topic. You said before it's about the exit strategy, and the exit strategy should be set on day one, which I agree with, absolutely. But now with tokenization of digital assets, and I don't want to dive into security utility at all, but you as a VC, or many of you as investors on the panel here, would you say that it is still very interesting for you to do equity in a blockchain startup, or is the tokenization of the assets and the liquidity they're good for, is that more interesting aspect to you? Would you say 50-50 or?
Wow, that's a really good question.
Yeah.
It's really well stated too. I think the deals I've been doing, they like to have both. I mean, like if you get a real whale, they'll try to get some equity, and then they're also going to try to get tokens, and they're going to try to get a big discount on the tokens. And the carpetbaggers that she was talking about will try to get what's called the trifecta, which is monthly fees, tokens, and equity.
Yeah, I mean, I'm struggling with the entire concept, to be honest with you, because there's, in many cases, an entire disconnect between, or what people are selling at least, between the value of the company and the value of the token, or what the token is intended to do. So me personally, as a professional investor, I wouldn't invest unless I'm seeing a value proposition of the business as a whole, unless I'm making a token investment like buying Ethereum because I think it's an investment and it's gonna go up. But the substantive underlying investment for me as an investor has to be with the core of the business. And the problem that I'm having with so many of these ICOs is the disconnect between the core of the business and the token.
Which is sometimes intentional to get away from the securities laws.
Correct.
But yeah, to me, I struggle with why I'd rather have a token. Let's say that it's a security token, disregarding the whole conversation. But let's say that it is because it represents some piece of equity in the company. Then why do I want, why is that better than actual stock? And I think, and there are reasons. It might be better than actual stock because it's liquid in a way that your stock in a privately held company is not. But it's also worse than stock in that you don't have rights to information that you do as a stockholder. So
voting rights, any rights.
Yeah. So maybe the best is to have some of each, so that you've got some liquidity and you also have voting rights and information rights. I don't know.
Yeah. So
Okay.
I was just going to sort of take it up just a little bit more high level, which is if you had asked me that directly, I would have just said my immediate answer would be like all the above. Right? At the start, it's like I will take every bit of the buffet I can. Number one, right? Just to be fully candid. Number two is that everyone's swinging for the fences, right? Everyone wants to be the next greatest company. Everyone wants to be the next 10 bagger where did all that stuff. But the real key, I think, to having generational wealth and what you see, especially among institutional players, is yes, everyone swing for the fences, but don't lose me money, right? And that's really the thing. So, and this really gets back to almost what you were saying, which is if there's such a disconnect between the two, well, then already my mind's thinking, oh, wait a minute, that's a big risk that I can't mitigate or I don't understand. Therefore, now I'm drifting into you're going to lose me money. Yeah. Maybe not, but I'm already leaning that way. And a maybe is usually a no, right? If I'm waffling, it's probably no. Why? Because I'm seeing 1,000 different opportunities, of which I'm going to pick 2, and therefore, let's just go to door B, door C.
And you have a fiduciary obligation to your investors.
That's right.
So
Is that maybe a little higher level?
Great.
Okay.
We have to wrap. Sorry, they're doing some filming in here. So thank the panel for me, please. They were great. Thank you, panel.
Brett Brown, everybody.
And can I ask you to